Okay, what we are discussing about the sessions in a market.
Yes, and then we did the quiz.
One second. It got hanged. Just a minute. It's not. Just allow me 2-3 minutes. Yes, we are discussing about sessions in a market, right? Then can anyone say what is closing session and post closing session? What happens? Am I audible?
Yes, sir. Yes,
Yeah.
you're audible.
Yeah. So can you say what are different sessions in the market and what happens during those sessions?
Sir, I don't remember exactly, but there is one pre pre-market or pre-opening session.
Yes, pre-open. What happens in pre-open?
Sir, the overnight orders are matched and the IEP is decided.
It's not only overnight. People are
Till
also allowed
9:15,
to.
9 to 9:15, the IEP is decided.
Yeah. So why it is required?
To get the new, to find the opening price for the day, sir.
Why we want opening price? Why not yesterday's closing price is today's opening price?
To adjust for any news that might have happened overnight, sir. To reduce
Yes.
volatility, basically.
Yes. So then what happens during 9:15 to 3:30? What is the auto square of time? What is auto square of time? Anyone?
I'm not sure, sir, but auto square off is near the close of the market, right? It's not at
Yes.
the opening time.
Not opening. I am asking you to 9:15 to 3:30. What happens between 9:15 to 3:30?
9:15 to 3:30, these are the market hours, sir, in which normal trading can happen.
Okay. In between something called block deal. What time block deal happens?
I think, sir, it's 9:15 to 9:50. I'm not sure.
Yes.
9:50 it ends. I'm not sure when it starts.
Yes. Yes. 9:15 to 9:50. So what happens in this block deal? What do you mean by block deal? Anyone?
Sir, transactions of above 5 lakh shares or 5 crore rupees are classified as block transactions because they can have a significant impact on the price. So these deals are happen separately and only when the buyer is also decided. Basically, when both the parties of the transaction are decided, it happens at one go.
Yes. So it's 5 lakh shares minimum or 5 crore of value, whichever is lower. Okay. Then another is auto square of time. Why auto square of time is required?
For the square of the unclosed positions.
Why it is, if auto square of time is not there, then what will happen?
The unclosed position will remain unclosed then.
Yeah. So it will be open only. So before 10 minutes, 15 minutes, 20 minutes, broker decides this auto square of time. Broker set this auto square of time. Okay. What happens in the closing and post closing session? Yes. What happens in the closing and post closing session? Closing session?
So closing session is when the closing price is decided based on the
Yes.
weighted average, based on the average of the last 30 minutes. Post
Yes.
closing, I'm not sure, sir.
Post closing, anyone? Saranya? So in the post closing, yes.
I'm also not exactly remembering.
So in closing session, we calculate the closing price considering 3 to 3:30 weighted average price, and this time is 3:30 to 3:40. The calculation happens in this 10 minutes, and 3:40 to 4 o'clock. This is post closing session. Market again opened up and when it is opened up, then trade will happen only with a single price, that is closing price only. Price movement will not be there. Only if any open positions are there still, then it can be squared off over here in the post closing session. And for that, broker also charges little penalty because you have not closed during the market hour. So apart from sessions in a market, what are the things we have seen? We have seen the circuit breaker. Yes or no? We have discussed the circuit breaker.
So we discussed it briefly.
Yes.
We discussed it briefly. You explained what is circuit breaker and market-wide circuit breaker, and
Yes.
the limits are set. When you open the NSE website, you showed us the limit, lower limit and upper limit set to break the
Yes.
circuit.
Yes. So we have seen stock wise. Then there are another kind of farm specific, but this farm specific in our Indian market we don't have this farm specific. We have stock wise price band. Then then we have market wide circuit breaker. How many times market wide circuit breaker has hit in Indian market so far? We have started applying from 2001. Yes. I have shown you the examples of different happenings that market wide circuit breaker has hit, like election day result or 2008 financial crisis or COVID or NSE's system error or SEBI's decision or regulatory decision. So far we have applied only 8 times market wide circuit breaker. Out of that, 2 times was from this COVID only. Okay. So today we will be discussing about modern portfolio theory, or it is called as Marquis theory. Marquis theory, or we call it as mean variance approach. Okay. Any one of you have studied this? And anyone of you have studied this? Yes.
We have just seen it in like little less detail, but basically Markowitz compares the mean as the expected return and
Yes.
variance as the risk factor, and
Yes.
talks about how we should be maximizing our expected return, which is mean, and minimizing our expected return. So he tries to create a spread around using the mean and using the expected return, and he uses that to classify
Yeah.
different portfolios.
Yes, the basic idea is to maximize our return. Okay, you maximize return and minimize risk. Okay, that is the basic idea of this mean variance approach. So I told you in our introduction class the story how Harry Marquis has developed this theory and how he has struggled to build up this trade-off or come out with an idea to work on the stock market. And his thesis was also rejected by the doctoral thesis committee members. Then later on, this particular theory got published in Journal of Finance. Journal of Finance is the topmost journal in finance area, and he got Nobel Prize in 1991 for this theory. In 1952 or 51. It got published in Journal of Finance 52. Okay. Now the question is, he has said like we can build our portfolio theory based on mean variance and we can maximize return and minimize profit. So after this 2008 financial crisis, there were so many discussions. So what we'll do is we'll learn how this modern portfolio theory has been built, and we'll do it through R as well as through Python. So both the way we'll do. In Python we can do, in R also we can do. So we'll see, whenever I have 10 stocks or I have 5 stocks or I have 20 stocks, how I can maximize return and minimize the risk, and based on that, how I can decide my investment strategy. Okay, so after, if you say you have selected, suppose say Asian Paint is your uh, Asian Paint is your uh, company which can be allocated higher weightage. Okay, whenever you are investing in 4 or 5 or 6, suppose say 6 companies you are investing. Okay, company 1, company 2, company 3, like that up to company 6. Now you need to invest 10,000 rupees. How much you will invest in company 1, how much with company 2, how much with company 3, and how much with company 4, 5 and 6. Okay, can anyone say, if you have to invest 10,000 rupees in 6 companies, how much you will invest in these 6 companies, each of the companies?
Sir, it depends on how much risk you are willing to take. Because each one
Yes.
will carry a different beta value and alpha and all.
Yeah.
You have to decide your target creeks first of all, and accordingly you have to optimize.
Okay, so one is you are considering the beta of these stocks and the risk factor. So this based on that you are forecasting whether this particular stock you will allocate more weightage or this more weightage or this more weightage. One way is equal weighted. Yes. Yes,
So what I'm
Ali.
saying is it's a game of risk and return.
Yeah.
So first of all, like the Markowitz theory will first tell you, the minimum variance point and all that things.
Yeah.
Then you decide where you want to stand on that line. So accordingly, you'll
Yeah.
have to allocate.
Yeah. So this beta is not related to Markowitz theory. Markowitz is not believing on beta as a risk. Markowitz believes variance as a risk factor. Yeah. So can anyone say what is the difference between beta and standard deviation?
So beta is the correlation with market. How market moves, the stock moves. For example, if beta is 1.2, then if the market moves by 1,000 points, it will move by 1,200 points. If it is zero point 0.8, then it will move by 800 points. Standard deviation is the dispersion of return from mean. So, for example, if the stock is regularly paying dividend or return of 10% and it has low deviation, that means it will consistently pay around 10%. But if it has high standard deviation, it may or may not pay 10%, it may pay 11%, 12%, or even 7%.
Yeah. So this beta is sensitiveness of the stock, and standard deviation measures the variation from its mean or dispersion from mean. Now, if you see, this is one is systematic risk, another is unsystematic risk. Which is systematic risk?
So the one which affects the entire market as a whole.
Beta is systematic risk or standard deviation is systematic risk?
So beta is systematic risk.
Beta is systematic risk. Yeah. And standard deviation is unsystematic risk. Yeah. So this modern portfolio theory is not believing on beta, it is considering the standard deviation or the variance for allocating the or for calculating the risk and allocating the weightage based on that risk factors. So we can give, now if we have 6 companies, we can equally divide this 10,000 rupees into 6 parts. Okay. So how much is coming?
So 1666.
1666. So you allocate in this company 1 to company 10, 1666. So this is called equally weighted, or you are investing same proportion of your total budget or total amount in same proportion in all the companies. So if you are doing equal weighted, whether you will be in a position to minimize risk and maximize return, can you minimize risk and maximize return if you are doing this equal weighted?
No, sir.
It may not. Okay. It may not, because each company carries different risk factors. Each company carries different returns. So we have to first analyze and assign based on this risk return. So the second part is value weighted. That means this value weighted will give weights based on the minimum risk and maximum return. So which is giving minimum risk and maximum return. So so investor can decide whether to allocate more to company 1 or more to company 6 or more to company 5. Okay. So if you have decided, suppose say you have invested more in Asian Paint, suppose Asian Paint is one of your company, less in or second highest in SBI. Suppose say you have invested 30% in Asian Paint, 20% in SBI, then others rest 50% in the other 4. Okay. Now, during time of crisis, suppose say pandemic, whether this allocation will give you minimum risk, maximum return? During this COVID period, if you, all of you have observed, market was not at all following any of the fundamental. So it was coming down. Whether your modern portfolio will work here during a emergency situation like COVID or financial crisis like 2008 financial crisis, whether this particular theory will work or not.
But it will not work because this theory is for unsystematic risk, not for the systematic risk.
Yes. So it is systematic risk, not for unsystematic. Second is whenever you build up any of the strategies, like either you go for any of the fundamental, technical, or any of the theory based, when emergencies or crisis happens, all the theory will not work. Okay, that is another part. So whenever emergencies are there, the market will not at all follow your fundamentals. Now the thing is, when 2008 financial crisis happened, so before that, if you have decided to invest in 10 stocks based on this theory, and you came out with risk return analysis, and you have also allocated your total invested fund in such a manner that your risk return trade-off will happen and your portfolio return will be more. Now what will happen, what has happened in 2008 financial crisis, none of these theory has worked. Then many like slowly in 2010-11, many of the newspapers have started writing like, this is the death of modern portfolio theory. You can see the death of modern portfolio theory. They said it has died in 2009. So it was the birth was 1952, 2009, and all the analysts also said it's not a appropriate theory for the investment. Now if you say this death of modern portfolio theory, is there any alternate theory to this? The theory which has got Nobel Prize, the theory which is, yes,
APT.
Okay, arbitrage pricing theory. Okay. That is little. Okay. Any other things? So there are no alternate to this modern portfolio theory. Okay. Arbitrage pricing theory is for arbitrage only, but for long-term investment, this modern portfolio theory you have to follow. Okay. Now there was a say survey whether modern portfolio theory has failed or this theory has worked. Okay. So whether modern portfolio theory has failed, 38% employees said, 38% respondents said, yes, it has failed. So then 43 have said, no, it has not failed. Then 19 said, we don't know. But why we are doing these things? What is the requirement of again doing the survey when we have got the proof that our market is, our portfolio is not following the portfolio theory?
I'm sorry, sir.
What is the requirement of doing this survey to get this, whether it has worked or not worked, or whether it has failed or not failed?
I'm not sure, sir.
So the basic idea is to understand whether this modern portfolio theory can be used for future decision making, for future investments. So during pandemic or during crisis, all theory fails. So that's how this theory also has failed. But 43% of the respondents said, no, this theory has not failed. It will succeed. And 38% said it has failed. So what this modern portfolio theory gives us, this was given by Harry Marquez in 1952, and he got Nobel Prize in 1990. Yes, 1990, after 38 years. And this is the modern portfolio theory because this is the base of all the theories developed later on in this portfolio. If you have studied all the portfolio theory, started from Sarpe or Lintner, and it has commonly referred as mean variance analysis, and it's a normative theory but widely applicable. This modern portfolio theory is widely applicable. Now, can I apply this modern portfolio theory to some specific stock and take a decision of my allocation or whether to invest on those stocks or not? The answer is yes, you can apply. You can see if you are confusing about 20 stocks, how you will allocate your, or 10 stocks or 5 stocks, how you will allocate your total fund. You can do this. So that is what we are going to do through R and Python. So we'll understand what this is. So in 1952, people were denying to accept this mean variance approach, but at the passage of time, people have learned that old truth is rectified, it is accepted. Now, this modern portfolio quantifies this risk and return so that we can diversify our portfolio. Why diversification is required?
So to minimize risk.
Minimize risk. Then maximize return. Okay. Suppose I will say I want to diversify between, say, HDFC and SBI. They are highly correlated. If they are 90% correlated, then can I diversify within these two?
No, sir, you cannot. You should not.
We should not. We can diversify, but that will not give any economic value. So we should not go for diversifying between highly correlated stocks. So have you seen one efficient frontier anytime like this umbrella?
Yes, sir.
Yes, sir. Yes.
Yes, sir.
What this umbrella gives us?
Sir, for each level of risk, the maximum amount of return that you can get, or for each level of return, the least risk possible.
Yeah, the
It's
minimum
basically-
risk will get. So how this is coming out, we'll just now understand. So diversification is more important because market is volatile and we want to get benefit out of that, so we can diversify. Then this particular theory captures the trade-off between risk and return. So whenever we are there in the market, whether we want to come out at this 5% profit or 10% profit or 15% profit or 2% profit or 1% profit, always we confuse, because if we come out with 2% profit, we suddenly market will go up to 5%. If we will come out from 5%, it will go to 10%. So this type of dilemma, like whether to come out from the market at what point whenever we have entered, that is also a big problem. Now there are certain assumptions of this theory. Each theories are having their own assumptions. So first is, investors consider each investment alternate as being presented by a probability distribution of expected returns over some holding period. So one single period will be there, holding period, some expected return. Now second is, for a given risk level, investors prefers higher return to lower return. Suppose same risk are there. So say 1% risk is there, 1% risk is there. But if one security is paying you 1.5% return, another is paying you 0.8% return, then you prefer 1.5%, because for same level of risk you want to have the you want to invest in the higher return. Then your portfolio includes all your assets and liabilities. How your portfolio includes all your assets and liabilities? Can anyone say?
Sir, assets, because like whatever you are like, buying will be part of your portfolio, and liability if you're borrowing or short selling something, so that will also be part of your.
Yeah, short selling. So now this short selling is not allowed in Indian market. Sorry, BTST is not allowed in Indian market. Buy today, sell tomorrow. But short selling is allowed, but leverage is not allowed now. From September 1, we have learned these two things, leverage and BTST. So these two are not allowed from September 1 onwards. SEBI has restricted these two. Okay. Then investors demonstrate diminishing marginal utility of wealth. What do you mean by diminishing marginal utility?
Sir, as we keep on increasing, consuming more and more units of a particular commodity, the marginal utility that we will be deriving out of that commodity will keep on decreasing.
Yeah. So how?
What that implies out here is that as you accumulate more wealth, the more risk averse you become. I think that is what.
Come
happens
again,
out here.
Neil. Come again, Neil.
As you accumulate more wealth, in comparison to your wealth, the more risk averse you get.
Okay. Okay. Anyone? Okay. So whenever you are investing for a given period of time, okay, you will get a certain amount of return, and this portfolio theory is saying you invest for a single period. Don't again carry forward to other period. Whenever you have decided your investment horizon is this 2 years or 3 years, don't again extend to other years. And whenever you are coming out with keep on investing in particular security, you may not get that much return in a further shifting to other periods. That is how this law of marginal utility. Yes, Rahul.
Sir, is it related to the time for which we are investing into this particular security?
Time is one. Yes, time is a major factor.
So, but like if you're investing for long term, you'll probably get more return. So why there would be a
Yeah.
marginal utility of wealth?
Yes, definitely. We suggest to invest for a long term. Now, this theory is saying whatever long term you decide for, suppose say 10 years, you calculate 10 years risk return, but don't carry forward again to 15 years. If you want to invest 15 years, invest first you analyze for 15 years risk and return, then you can invest for 15 years. Then again, don't go for 20 years. Okay, that is how it is related here.
Okay, sir.
Then the investor's holding period horizon is single period, and investor estimates the risk of the portfolio on the basis of variability of the expected return. How much this expected return will vary. Now, this Marquis portfolio theory quantifies risk, which helps us to diversify expected rate of return for a portfolio asset and expected risk measures. So it shows that variance of the rate of return is a meaningful measure of portfolio risk. Now we have learned about calculating the single stock return. Through R we have done this single stock return and single stock risk like standard deviation or variance. We have done.
Sir, we
No,
haven't
sir.
done it, but I think everybody is aware of how to calculate mean and standard deviation.
We have done it also.
Maybe I missed that class, so because I missed a couple of classes.
Yes, sir, we did returns and
We
risk
did.
of stocks.
We did that. Okay. Now we have also hypothetically built one portfolio, but that was not based on any of the theory. We have just means randomly we are allocating some weights, and we have done that. But now we will go through this portfolio risk return based on the portfolio theory, so that we will come out with a efficient portfolio or building one efficient investment. So that when we say efficient, that will give us a good amount of return at minimum level of risk. Okay. So first it derives the formula computing the variance of portfolio, like it showing how to effectively we can diversify our portfolio. So all of you are aware what variance is or standard deviation is. It is the square root of standard deviation is square root of variance, and variance is the measure of possible rates of return, that is RI. RI means return of ith security from expected rate of return ERI. So it is the how much variation may happen. So if we see we add one probability. If Pi is the probability of possible rate of return, if we want to calculate the variance of return of an individual investment, we call it as RI, variance of RI. Then we say RI minus ERI square, then Pi, that is the probability attached to that particular security. Then if we come out with variance or return of individual investment, then we can come with the standard deviation. Then we just square root of the same thing. Then what is coming out with? Sorry. So if we come out with this standard deviation or the variance, just we square root this and get the standard deviation. Then what we are getting is, suppose say variance of we got like variance is 0.0050 and standard deviation is 0.022. Now how we can compute the return and how much return we'll get, and how what will be our portfolio return and portfolio risk. If you see, suppose some of the examples are there on closing price of Coca-Cola and closing price of our home report. So if you are adding the dividend with it and you are getting returns calculated, you will get return of all the periods. This is monthly return, and suppose Coca-Cola has given minus 1.18% average return, and our home has given 1.47% of average return. Now what is that you will now do? One is covariance. What do you mean by covariance? Anyone? What do you mean by covariance? Ali?
Like how both the two variables are varying together, kind of like
Yes.
joint
How-
variability type.
How they move together. Okay. So we have suppose say two returns. One is return I and another is return on security J. So that means first security return and second security return, or ith security and jth security. Now how we'll take this covariance of return and decide how much we'll do. So this correlation coefficient, first we'll see what this correlation coefficient is. So it is obtained by standardizing, dividing the covariance by product of the individual standard deviations. Now what we are getting is correlation can vary -1 to +1, and correlation is covariance of ij divided by standard deviation I by standard deviation of j. Okay, that is how we are getting correlation. Now the correlation, if it is -1, that means what? If it is 0, that means what? If it is 1, that means what? Yeah, all of you know this. What can anyone say? If between two securities, security I and security J, we get correlation is -1. What does it mean?
So the stock moves in negative direction. Suppose I and J have negative correlation of -1. I will move in the opposite direction of the same magnitude of J. If it is 0, that means it will not move. It is +1, that means it moves perfectly correlated in a tandem way.
Yes, good. So they will move in opposite direction with the same magnitude. If one is moving by 0.5% off, other will come down by 0.5%. Okay. That means whatever moment it is gone up, other will come down. If one will come down, then other will go up. Okay. One second. Okay, so sorry, if it is 0, that means they don't correlate it with each other. If it is +1, then they move with the same direction. Both move with the same direction. If it is going up, that second one will also go up. Now where diversification will give you more value, whether in +1 or -1? Correlation, if
So it
value.
depends on the outlook of investor, whether he's aggressive or whether he's conservative investor.
Okay, so tell aggressive investor how much he will go.
So if I'm an aggressive investor and if the long run outturn is bullish, then I'll prefer the higher correlation, that is +1, because when the Sensex increases, the value of stock will also increase.
We are not going for sensitivity with the market. We are now calculating with two securities or two shares. Suppose say SBI and HDFC.
So then aggressive investor will go for +1 in this scenario correlation, because he wants to maximize his return, and conservative will go for -1 in case of it is bearish market.
Okay, so it depends also nature of the investor, but the portfolio theory says we can go for -1 to have a to maximize our return and minimize our risk. But if we are in +1, we are going for a long term and we are expecting both will go up or both will move up, then we can have there in our portfolio. But this modern portfolio theory is saying it is good to have -1. How it is, we'll just see. So this is what -1 and +1 is, or the correlation that we are getting perfectly correlated positively or negatively. Now the portfolio maybe have two characteristics. One is expected rate of return, another is expected standard deviation of return, and correlation measured by covariance affects the standard deviation. Low correlation will reduce the portfolio risk while not affecting the portfolio return. So how do we get portfolio standard deviation? So all of you are aware about standard deviation?
Yes, sir.
Yeah. How we get standard deviation? Just one second. Yeah. So how we get standard deviation?
Under root of x minus x bar divided by n.
Okay. Yeah. Come again.
X minus x bar divided by n. The whole is square root.
Square root. Okay. Now we can get each of the security standard deviation. Now if we will say I want portfolio standard deviation, you take that n is I equals to 1 to n, and you give weights to that, weight of ith security and standard deviation of ith security. Then you say weight I, weight j, and covariance between this ij. So you will come out with portfolio standard deviation. Okay. Now why we need this portfolio standard deviation? Because we want portfolio risk and portfolio return to be calculated to come out with this minimum risk maximum return portfolio. Okay. And weight is given on the individual assets that I have showed you, like weight can be given randomly or weight can be given equally. So when we say randomly, it is valuated. When equally, we divide blindly to equal weights we give to each of these securities. Now, if we come with two securities, now we have security A and security B, then standard deviation or portfolio variance or portfolio standard deviation is xa square and standard deviation a square, or say variance a, then xb variance b, 2 multiplied by xa xb, then probability of ab, and standard deviation a, standard deviation b. Now how do we say return variance is in a securities total risk? We'll say how much we are getting or based on portfolio standard deviation, how much we will get the return. So portfolio standard deviation we can write on this way: xa then variance a, xb variance b, then 2. So it's like a plus b whole square. Now most investors want portfolio variance to be as low as possible without having to give up any return. So we want to reduce this means or to minimize this risk. So this is the total risk. Then this is the risk from A, risk from B. Then we say interactive risk between A and B. Now if we are having two assets, asset 1 and asset 2, and we are getting this correlation is say 1. Now how the risk return trade-off happens, or
So
or
risk
how our
increases,
yes.
risk will increase and your return will be lower comparatively.
So they both are positively related, highly positively related. Okay. Now, either you can have one or you can have two. You should not have these two, but things are different from different investors. If anyone wants to have HDFC SBI in both, then he has to take a little higher risk for a long term. But this portfolio theory says don't consider these two in your asset. Now you say relation, now this correlation between I and J, that means two securities, are zero. If correlation is zero, that means they are uncorrelated. If they are uncorrelated, how the risk return will plot will uh, come, or you can say, or this is, yeah. So this was correlation one that in the first case we have seen. Now if a correlation is zero, then we will get risk return with in this type. If you one risk is or one return is this much, another is giving this much return, then we will come out with a risk return trade-off. This is actually a called as efficient frontier in portfolio theory. Now just increase this. If you have correlation of plus 50, then we'll come out with we'll also come out with one efficient frontier, or we'll come out with some combination of risk and return, which will give us some economic value. But in case we are coming out with negative 50% correlation, so then negative 50% means then the correlation or the efficient frontier or the risk return trade-off is coming like a U. Okay, so so diversification will be more valuable in this case. Okay, in this case as compared to this correlation one. So this is the first case correlation 1, second case correlation 0, third case correlation plus 50, fourth case correlation is minus 50. Now you come out with correlation -1. Again your both are like both will move in the opposite direction. Okay, one is if you both are negatively correlated, both will move in opposite direction. So your diversification is giving you maximum value when you are with the negative correlated or highly negatively correlated.
Sir, what is the reason for the shapes? I'm still not very clear. I'm only clear on when r equals to 1. But after that, I'm not very sure how are we getting those shapes like that.
So there are two, so you can see this point. There are two securities. This security is having this much risk and return. You can say this is your risk and this is your return. Okay. If you are moving with this security, your risk is high but return is low. If you are moving with another security, risk is high but return is high. If you are putting this security 1, this is security 1 and this is security 2. If you are putting security 1, security 2 in your portfolio both, then you can diversify your risk and return. You can maximize your risk and return. Are you getting? So this is how this.
The basic concept I'm getting, but I'm still not being able to understand how can one assign the shape of the two portfolios. Right. See, sir, I'm very clear if when r equals to 1, what will happen, because it gives us the equation of a straight line between 2 points, right?
Yes.
Which is weight of the first point and weight of the second point divided by the sum of weights.
Yes.
But sir, how are we getting, like, how do we understand what the curve is when it comes to when the r's are not the same? R is not equal to 1. I'm not understanding that, sir.
Okay. So let us take one example. There are suppose say one is risk, another is return. Okay, two you can take. So when correlation, another is correlation you take. When correlation is minus say 4, okay, minus 0.4 or 40% correlation, you are getting say a 2% return. Okay, risk you are getting say 1.5% risk or 1% risk. If it is again risk is suppose say minus 0.3, you are getting say same risk same return. But when it is opposite, suppose say they are negatively correlated, means another is plus 4, you are getting something say 4% return with same level of risk. And if you are coming out with a plus 3%, some 4% will or 4% with say different level of risk or same level of risk. If we will plot this, the same, I have two things. One is risk, another is return. Okay, I have two securities. I'm saying if risk will increase, return will increase. That is basic understanding, but it doesn't happen. When risk is increasing, return will increase. I have two negatively correlated stock. In one case, when risk is increasing, return is increasing. In another case, when risk is increasing, return is decreasing. Because when I was there in suppose say portfolio B or security B, and this is security A, if I was getting this much return, suppose this is the risk and return. Suppose I was getting this much return, say 5, 10, 15 with 5, and this is the return. With 5 unit of risk, I was getting suppose same 2 unit of return or 10 units of return, whatever you can say, 2 units of return. Now, if my risk is increasing, I am getting lower return. Okay. If risk is increasing, I am getting lower return. Now the same risk is increasing with other stock, I am getting higher return, because they both are negatively correlated. I am getting higher return. Neil, are you getting?
So just one question.
Yeah.
Here, when you say that, so is the idea of having different correlations or different proportion of allocation?
Yeah, different proportion of allocation. Now, one is we'll put different correlated, means oppositely correlated stocks. Now, question is how much I will allocate to A, how much I will allocate to B. I will put both of them in my portfolio. How much I will allocate to A and how much I will allocate to B.
So basically, the proportion of allocation will decide the shape of my curve, right?
Yeah.
Okay.
Yeah. It will decide my shape of the curve. That is what the theory will give us, or the basic objective is to find the allocation, so that it will give me a curve like this, which will diversify my portfolio. Neil, are you getting how we are getting the curve like this?
So not entirely, but sir, it's fine. I think we should move ahead. I'll look it up.
Sir, is there a software or tool to draw the curve?
Yeah, we'll draw the curve. Our objective is to get that curve only through R and Python, even through Excel also. But in Excel, you have some limitation. You can't increase more than 4 securities. But through R and Python, you can use for n number of securities. We'll do that. Okay. So then Neil, you can go through it. If again you have any question in the next class, you can ask. Okay.
Yes, sir. No issues, sir.
Yeah. So this is how we are coming out with a this is called efficient frontier in Marquis theory, or in Marquis portfolio theory that it is provided. So suppose to have perfectly negatively correlation, then would it make sense to invest in these two securities only? We can come out with this part is negatively correlated. We can come out with a something called efficient frontier. How we'll do this efficient frontier, or what does this efficient frontier gives us? This efficient frontier represents that set of portfolio with the maximum rate of return or every given level of risk. That is how we have seen. These are risk and these are return. So we will come out with a set of portfolio return with a maximum rate of return for a given level of risk, or the minimum risk for every level of return. If we are asked to decide a given level of risk, what you will and which return you will select, we will say highest return. Okay, and given level of return, which one you will select with different risk, we say lowest risk. Okay, lowest risk. That's how this frontier or efficient frontier. So this is portfolio theory, and it is not for individual security. It is for portfolio of investments. When we say portfolio of investments, it's in the group of companies or number of companies. Okay. So the expectation is the getting the highest return with those assets, and deciding whether to go for this. If we are going for this, how we will allocate the our particular investment or weightage. Okay. Now, individual investors' utility curve specifies the trade-off he is willing to make between expected return and risk. I hope all of you have studied the indifference curve. I see.
Yes, sir.
What that indifference curve gives us. What is the indifference curve indicates to us?
Sir, for any
The
2 points
utility provides utility measures, sir. We can measure the utility of the two goods, sir, with the same utility. I think
Yes.
like this.
Yes. So by getting that utility curve, we are also having different indifference curves, and we are seeing one tangency of independence curve. Have you done that tangency of independence curve? Suppose I have different indifference curve. Okay. So again, convex and concave you have seen?
Yes, sir, we have seen.
So we'll come out with a tangency where
Maximum utility we can get, sir.
maximum utility we can get. That is called that is here called as efficient frontiers maximum utility also. So one individual investor's utility curve specifies the trade-off he is willing to make between expected return and risk, and that slope of that efficient frontier curve decreases steadily as you move forward. These two interaction will determine the particular portfolio by an individual investor. Now just see, you can have different utility curve or indifference curve, and you are coming with two things. At what point you can enter, or what point will give you maximum return with minimum risk. This is called optimal portfolio with the highest utility for a given investor. It lies at the point of tangency between the efficient frontier and the utility curve. So efficient frontier is your umbrella, and utility curve is like this. Then whenever tangency happens, that is the point where you will get your utility, or you will get the minimum return and maximum return and minimum risk. Now, how the MPT investment process happens? You just see expected return, then you find volatility or standard deviation and correlation estimates, then portfolio optimization, then you see risk return efficient frontier, and find the optimal portfolio, and gives the investors, based on investors objective, they will allocate that or invest that, or else you can go for constant on portfolio choice and maximize it. Now, if we come out with this asset pricing model, one major thing we consider is risk-free rate of return. Whenever you have seen in the CAPM model, uh, RI minus RF equals to what is CAPM model? Can anyone say?
So the Ri equal to Rf plus beta into Rm minus Rf.
Yes. So that is alpha only, RF plus beta into RM minus RF. Okay. So this we call it as a risk premium. Either you can have Ri minus RF, or simply you can say Ri equals to RF plus beta into Rm minus RF. What is this RF? Why we are giving more importance to this RF? Can anyone say?
Sir, it is basically we are trying to get extra returns from taking the risk in the market. So whatever is being offered by the risk-free asset, that is what we are already expecting, and over that, whatever this particular asset will be giving to us. So that is why we are focusing on RF.
Okay. Anyone? Good. Rahul has given good. Anyone? Why we are going for this RF?
Sir, I agree with Rahul because in today's age, it is considered that anybody who has the option to enter the market also has the option to enter into risk-free investments.
Yes.
So given that understanding, as Rahul had mentioned, what is the additional return that you get if you enter a risky market or the market in general from that safe point? So that
Okay.
is opportunity cost, you can say.
Yeah. So what we are saying is, whenever without taking any risk, we are getting some amount of return. Whenever we are taking some additional risk, we should get some extra amount of return. Okay. Then the risk-free rate of return. Yes or no? Yes or no?
Yes, sir.
So if I am saying RF, what will be my RF? What return I will consider as the risk-free return? Which return I will consider as risk-free return?
So government bonds.
Government. Yes.
Treasury bills and all the, sir.
T-bills or GSEC.
91 days, 365 days.
91 days T-bills or GSEC. Now GSEC return is 6%. So can I consider this risk-free rate of return is 6%? Can I?
Yes, sir.
So if you are getting on daily basis 6% return in a government securities, why you will participate in the equity market?
Because you want to beat the government security return. You are ready to take up risk just so
But
that you can actually make a more return.
can you get on a daily basis higher return than 6%?
So the 6% is not daily.
Yeah, that is what I was asking.
So,
Yes,
so it's
this
not a
is
daily
for
rate of 6%. This is
this is
annual.
for 365 days
Yeah.
or 252 trading days we call it as, but
Correct.
since we have to, this is annualized, we have to take the daily return. So don't take the risk free as it is given. This is given on an per annum basis. If someone will get on a daily basis 6% return from government securities, then no one will go and participate in the equity market. Yes or no? Yes or no?
Yes, sir. If anyone gets
Yes, sir.
6% daily, he'll have an income tax rate on him, sir.
Income tax rate, why? You are earning from the market. It's your earning, and you will give the capital gain tax.
Sir, it was a joke,
Sir,
sir.
if
No,
not,
no
sir,
issues,
if
sir.
not income tax, then SEBI Pakka will come.
SEBI will come. You have some insider news. That's why you are earning. So verification will be, investigation will be going on. Okay. So that is how we come out with risk-free return. There are some benchmark rates also. You have heard about MIBOR, LIBOR.
Yes, sir.
Yes, sir.
So when we are considering the daily data, we can also we can also go for this overnight MIBOR and overnight LIBOR rates. So it depends on any of these, either benchmark or GSEC return or T-bills return can be considered as risk-free return, because without taking any risk we are getting that much of return, because the risk of default is zero, and we are getting some fixed amount of return out of those securities, since these are fixed income securities. Okay. Now whatever we have discussed, now we come out with this summary. A asset with zero standard deviation, that is called risk-free asset, zero correlation with other risky assets, and provides the risk-free rate of return, and will lie in the vertical axis of a portfolio graph. Now, what is the covariance and correlation between risk-free asset and risky asset?
Sir, 0.
It will be 0. Okay. This covariance between two sets of assets, so it will be 0. The covariance between risk-free and risky asset will be 0. Okay. So what we are why we are more concerned about this covariance? Because we are going to build our portfolio, and we'll see how the securities in our portfolio are related. Okay. Now, when we are coming out with this portfolio risk and return, or this modern portfolio theory, what it is saying, the expected return, portfolio return, is the function of weight of risk-free return plus 1 minus weight of risk-free return into expected rate of return of our securities or our portfolios. If you want to keep two portfolio or two securities, one is you are going to invest in a fixed income securities or a government bond, another is you are going to invest in equity. So you have all alternatives of asset classes. Now you have to decide how much you will invest in where. So many times what happens, whenever any of the adverse situations are there, you will get some amount of fixed return. So many are also going for GSEC funds or even liquid funds, money market funds to invest, so that diversification happens. Now, how you will come out with the trade-off between this risk-free return and risky return? The expected, say you combine a risk-free asset with a risky asset, so that you will come out with a minimum risk and maximum return. So the same way you assign the weights to first security and second security, and just take the product of these weights and correlation or covariance and standard deviation 1 and 2. Then you will come out with you are substituting the risk-free rate for security 1 and risk-free rate for security 2. Then you are coming out with the weights of risk-free and standard deviation risk-free. Then 1 minus RF like weight of risk-free return standard deviation I. Then you are coming with just 1 minus WRF. Now what you are getting, since we know that variance of the risk-free asset is 0 and the correlation between the risk-free asset and any risky asset is 0, we can again further adjust the formula. It will come as expected return of portfolio is 1 minus WRF into variance of a risky asset or security I. So this formula we are getting if we are combining with a risky asset with risk-free asset, and if we will just square root, we will get the standard deviation. Now 1 minus weight of risk-free return multiplied by standard deviation of I is our portfolio, or what we will get is efficient frontier. Now, what does this efficient frontier will give us? This efficient frontier will give us, suppose say this is risk or standard deviation of portfolio and return of portfolio. If we will move on this curve, our risk will increase and return will increase. But after some time, it may happen, this will come down. That's why this is the maximum point we can go. Beyond that, it is not advisable to go. That is how we come out with the efficient frontier. With given level of risk, we are getting some amount of return. Okay, and in this efficient frontier, we will have different points of combination of risk and return. We have to select on what point we will go, and we will come out with the tangency. This is what? This tangency is giving us the maximum utility. Yes or no? The point of
Yes, sir, correct.
tangency gives us maximum utility. So this is how this modern portfolio theory is. Now we will move to do this with
So I just wanted to ask,
yes.
how did we select the slope of the straight line again?
Slope of straight line is based on the risk and return of these two securities.
All right, sir.
So now you will do practically also. You will see how this slope is coming, or how this efficient frontier is coming. Okay, just I'll just mail you some files. Okay. So download all the files that I have sent you now, and keep in one folder. One I have sent you the R file for this portfolio theory. Then some of the data sets, 4 data sets I have sent you of 4 different asset classes. Just download it. All of you got it?
Not yet, sir. Yep, we got it, sir.
Yeah. So just download it and open it.
what exactly should we open, the R file or the CSV?
R file. CSV you need to import.
Okay, so got it.
How many of you have downloaded? Please raise your hand. Only 8, 9, 10, 12, 11, 13. So what about others? Others are downloading or not downloading? All of you have received, right? You are 32 downloading. Okay, Neil. Okay. Okay, we can wait for 1 minute, 2 minutes. You just 2 minutes. Okay, another is Sharpe ratio. I hope all of you have done this. Yes or no? Anyone? All of you are aware about Sharpe ratio?
Sir, I'm not sure, but it is basically you compare your investment to the risk-free rate and something like that.
Yes. It is like
So there are two ratios. I forget the other one. One compares to beta and one compares to standard deviation.
yeah. So beta and standard deviation, Sharpe Jensen. Again, another is Jensen ratio. So this Sharpe ratio is saying how much. This is for through standard deviation. How much return we are getting with each level of risk, or it is called as reward to risk, or reward to get for each level of risk how much return, or return with considering the risk, or how much return we are getting by considering 1 unit of risk. So that Sharpe ratio will also give us that was developed by William Sharpe. That will also give us. So we'll apply that Sharpe ratio in this efficient frontier as well. Okay. To see the again out of this efficient frontier, which is giving the maximum Sharpe ratio, we'll also say that. So Neil, you have done it.
So we had to just briefly see it in our SAPM module. So there were two ratios. I forget the name of the other one, but I distinctly remember that in one of them, in the denominator you have beta, and one of them you have standard deviation.
Yeah, the other one is Jensen's ratio. I have Jensen's alpha. Another is Lintner is also there. So there are other ways. Yeah. Okay. So you have downloaded, Neil?
Yes, sir. Downloaded and also set off in directory, sir.
Okay. So how many of you have downloaded so far? Can you raise your hand? All those who have raised earlier also raise your hand. 15. Only half of the class is downloaded. What about others? Whether others are there? or simply they have joined? All of you are there? 20. Oh, good. Now 20 came. What about again other 10, 12, 11? Okay. Okay. So let us go to our R file. What we'll do is first import two data sets. One is SPI, that is S&P, and another is SPAB, that is the bond market or ETF return data. ETF data that will get the return, and we'll consider that as a risk-free rate of return. Okay. Now we have learned something called daily return in the previous classes. We are using quant mode, the library quant mode, and we are calculating the daily return. Yes or no?
Yes, sir, correct.
Another function is delt, D-E-L-T. This delt function also give you the return, that we'll use delt over here. Now what you do, you just set your work directory wherever you are keeping those files. Don't keep it in download, keep it in your folder where you are say using it. So create one computational finance folder or any of the name of the folder. Then you keep all these data sets and the R file there. So you can set your work directory. All of you are aware how to set work directory?
Yes, sir.
So now set your work directory. Set your work directory. Then you just import the data. You just say read.csv, whatever. So these two you can remove. For my file it is two. I think you got this SPI. So remove these two. Now just declare this as age dot date. Okay. And you can see the head of this data. You have, what are the data you have? You have date, open, high, low, then close, then volume, and adjusted close. What is difference between close and adjusted close? Anyone?
Sir, adjusted close takes into account any stock splits, dividend announcements, etc., etc.
Yes. Yes, all the corporate actions will be adjusted in the adjusted close. So always consider the adjusted close data. So always consider the adjusted close data so that you will come out with the right series. Whenever you are coming out with only closing price, it is not adjusted, then it will give you, whenever stock splits or dividend announcement are there, it will not adjust that. Okay. Now yes, what we are doing is we are declaring this date as date. Now date has been considered here as one of the variable. So we will consider that date as date. So in the data, you just consider that. Then we need one library called library XTS. Okay. So library XTS, we'll declare this as time series. So if you have not downloaded or installed this library XTS, just download and install it. Okay. If you have, then open it with the library. You have this XTS. I hope you are having, because you have used the time series model, right?
Yes, so I think most of us have XTS.
Just check it. If it is not having, then you can just open it through library. Okay, then you declare this as XTS, this particular data, from second column to seventh column, because first column is already date. Yeah, and you can name these variables. So now it is coming as open, high, low, close. So whenever you will consistently work with other files column will also be open, high, low, close. Just give name of this file as SPI open, SPI high, SPI close. Just say names, then data file name, then paste, then C, and write down all these before this name, thus SPI dot. Okay. All of you are
I
able
don't
to
understand.
run up to
What
this.
will we do here, sir? When we applied names, are we are we just renaming these columns or what exactly?
Yeah, we are renaming the column
Okay, sir.
because all data file from Yahoo Finance or from this file will have open, high, low, close. Okay. So if one file SPY is having open, high, low, close, and other file, suppose say SPAB, will also have open, high, low, close, how will you differentiate from each other? Just rename it. Okay. So done. This is.
So just a doubt.
Yeah.
In so two doubts. The first code,
Yes.
so data.spy, when we do cbind, date.data.spy, and we do that -1, does that -1 drop that old date format for us?
It will,
Minus-
yeah, all that format. Yes.
Okay, and so the next thing I wanted to ask is, in the names code, names data.spy, that paste we are writing, what does that paste do?
Paste means whatever here is there, na, date, open, high, low, close. We want to paste these names in place of this. In place of open, I want to paste SPI dot open, not open.
Oh, okay.
High
I
SPI.
thought that even without doing paste, I thought it used to happen.
No. So you can check with the head or names of now with data SPI. You can now check head of data dot SPI. Now you got the difference. SPI dot open, SPI dot high, SPI
Yes,
dot
sir,
low.
yes, sir.
Okay, this is what this will differentiate, since you will be using four files. Four files will have all these open, high, low, close. Now we want to differentiate each one of them. We'll write down. Okay. Then library quant mode in earlier class, those who were present, you have installed. Those who have not installed, now you need to install that quant mode and open that library quant mode. So this library quant mode is the financial computing or maximum financial functions are there in this quant mode. Okay. So one best thing is we can get the return inbuilt return commands through this quant mode. One we were using on the other class was daily return, monthly return, weekly return, or yearly return. Another we'll use here is DELT, DELT. That will give us the return also. Now we'll get this data as monthly data. Now daily prices are available with us. So these are all daily prices. Now we want to build this with monthly data, so we can convert it into 2.monthly. so that you can convert the daily data into monthly data and calculate the return of monthly return. Okay. So now you just use this SPI.monthly, whatever name you give in the left hand side, but the right hand side you have to give 2.monthly, then data.SPI.
Sir, this
Now
2 dot
you
monthly
want
will calculate monthly returns.
which one? No, monthly data we are getting now. Monthly return we will get in this
So then, sir,
function. Delta.
in that case, sir, could you just explain again what this 2 dot monthly will do?
That means the daily data will be converted into monthly data. Now we
Okay.
have daily data. We are now converting into monthly data. Okay. So you can write down by taking hash over here. So convert daily data into monthly. Daily data into
Okay, and sir,
monthly.
one more question.
Yeah.
Suppose my data was weekly data. In that case, would this function still work, or will it need to be
No,
amended?
not this weekly to monthly. Yes, weekly to monthly it will work.
It will
But
work.
if
Okay.
you want monthly to weekly or monthly to daily, some reverse functions are there. I just missed that. Suppose you want monthly data to convert it into daily data. So the reverse way. Now we are doing daily data into monthly
Got it.
data. Yeah. So again, out of this, all these, suppose say you just say names of this SPI.monthly, you are getting this all these names. Now you want to
So just a doubt.
Yeah.
2 monthly, is it finding the average for the month or what is it doing?
Yeah, average for the month.
All right. And sir, with respect to volume, is it adding up all the volumes or is it again just finding the average volume?
Monthly average volume will take.
All right.
It will not add. Yeah.
Yeah, because I think for volume it'll be a little better if, I mean, but then we can't explain that to the code.
Yeah, art means it will be the like you are doing average for others and volume if will do, it will be different. Okay. Now just say we want to work on this adjusted closing price. We have named that SPI dot say adjusted. You use that that is in the 6th column. So consider that 6th column only now. Okay. Now what we are getting over here is SPI dot monthly of 6th column. So just say give comma and 6. That means before this row, after the comma, column. In the R, all of you are aware. So before comma is row, after comma is column. Now you want 6th column, call that 6th column. Now in SPI monthly, what is there? Suppose say now in SPI monthly only adjusted closing price is there. So data filterization is over and we got all these monthly data. Yes or no?
Correct. So yeah.
Now we will calculate the monthly return. Okay. The function is dealt the same ln pt by pt minus 1 multiplied by 100. This same is monthly return.
You have a doubt?
Yeah.
Sir, if we are converting this to monthly data, what is happening to our daily values? Could you explain that part again?
Daily value will average to monthly.
They are basically averaged out based on
Yeah.
number of days. Okay, sir.
Yeah. Got it?
Sir, but is it a correct representation of our data? If we're just averaging it out for the month?
Yeah, suppose I daily trading is happening. Okay. Daily I am getting one closing price. If I want to represent what is the monthly monthly trading or monthly price, I can just take the monthly average of price. That is the good representation. What is the wrong with this, Rahul?
Sir, basically in a time series, we say that order matters a lot. So basically, every value of the next day is a function of a previous day value, right? So if we are just simply taking the average, should it not affect the kind of returns that we are calculating? It is basically giving us a simple representation that, like, on an average, the value of the stock was this much. But when I'm calculating my own returns, so would it be a fair measurement of my returns also?
Yeah,
That's
it
what
will be. It will be. Why? Because the same. Whenever we are calculating this closing price, what is that closing price? Closing price is the weighted average price of last half an hour. That is what we have learned in previous class. Half an hour of every day. Yes or no?
Yes, sir.
Now what we are getting every day, one closing price we are getting, or adjusted closing price we are getting. If we, this is each day's average. Okay, each day's half an hour average. Now I am taking, if I want to take 30 days or 22 trading days average, then what is the wrong with that? It will not. I want monthly return now. I don't want daily
Yes, sir.
return. For monthly return, there will be no problem. Na? Are you getting?
Well, no, I don't think so, sir. Matlab, I feel like, see, when we are talking about time series and we are taking for a longer period of time, so there would be certain clusters, there could be a trend, there could be anything in that particular data.
Exactly.
But if we are just taking an average, so there'll be like, single point based on like, so that would be more or less like a linear line or something. So then the essence of time series gets lost if we are taking average of such data.
Yeah.
So that's why I'm not
Yeah,
very
there are lacunas of averages. You are correct. You have seen, you have heard about some story of one statistician was crossing the river. Have you heard about that average, Rahul?
No, sir.
Okay, so one statistician, actually this statistician or mathematician always play with numbers. So he was crossing the river with his family members, and his parents, kids, his spouse, all were there with him. And they have found that the height of, they have to cross one river. Okay, they have to cross one river, and they have to cross by foot only. There are nothing to cross that river. The height of the river, the water height of that river is 4 feet, and they have seen like he has calculated the average height of their family members. It was 5 feet. So they can cross easily 5.5, suppose say 5.5 feet. They will cross easily this river, yes or no? So the height of the river was 4 feet, and the average height of their family members are 5.5 feet. So all family members can easily cross the river.
Yes, sir.
Yes, when they have crossed that river, they have lost their kid, which was 2 feet. Okay, that was averages has this lacuna. Whenever you say average, what you are saying is actually correct. Whenever we are saying, suppose every individual's actual value, it is different and average is different. That is why we come out with dispersion and we come out with how much difference is there from its actual. So that is why it is happening. Okay, what you are saying is that is correct. Every day, suppose say suppose one day it has gone up by 10%, market has gone, or security price. Second day it has come down by 5%, or in one day it has come down, suppose say circuit breaker has hit it, it has come down by 15% or 12%, but other day it has gone up by 20%. So much fluctuation has happened over the month every day, and if we are considering the average of that, we are just killing these moments. That is what your point is, Rahul, right?
Yes, sir.
Yeah, that is correct. Average has that lacuna, but whenever we want to represent a monthly value, we don't have any alternate to do that. We have to take the average. Yeah. That is how all the monthly or yearly representation happens in case of market. Okay.
So it could be a tedious process, but can we not apply time series itself to come to the mean value of the month itself? When we talk about long run volatility or something. So if we are taking this because in time series you can actually take fraction of every say for example 5 minutes movement also if you're taking into that consideration it also or even for that matter every day also it becomes a time series itself, right? So then why are we not applying any time series algorithm itself to compute the mean value of this particular month that we are talking about rather than taking simple average of all the values that we collect?
So how you are taking time series mean value?
Uh, so basically, if there is anything that we observe within that month also, so we can generalize it to we can detrend or make it stationary and then compute the basically satisfy those assumption of stationary mean sorry constant mean and variance. So that way whatever mean we would be getting for this particular series, would that not be more
No. What you are saying is that was time series requirement.
right?
Those stationary, non-stationary, those are different cases. When you say stationary, non-stationary, that is only applicable when you apply this econometrics part. If you say, suppose in non-stationary, you are losing so much information. Have you observed that? In non-stationary you are losing so much of observations. Suppose your prices has actual price is this, okay? When you convert it into, this was non-stationary because it is followed a random walk. Now if you are saying you will bring down that return series or difference, now this becomes a constant mean, constant variance and constant covariance, and this is stationary. Now, in this process, whether we are losing any information or not, we are losing more information. And this is not the calculation of mean, this is the difference. And then we are saying on the difference, what is the mean? Okay, this is not also calculation of mean. On the difference, what is the mean we are saying? And again, we are losing so many informations over here. That's why machine learning techniques and other techniques which are not having this stationary as property, they criticize these time series models on this ground, because whenever you take second difference, again you lose so many informations. Okay, this fluctuations brought down to this level, again it is bringing down to this level. So every process has some or other lacuna, but whenever we apply, we satisfy their property only. It's not for mean, Rahul. You
Yes,
are
sir.
you are not calculating mean there. You are calculating the difference series mean. Okay. So should we proceed further? We'll just complete up to this, then we may stop. Okay, so if you do this delt of that SPI adjusted, you can simply take this delt and you can see how this you give the return or series name as SPI dot return. Sivani, I will call you in 2 minutes. So this SPI dot return, then you are getting the return of this SPI adjusted data. Now you can get this and see how what is the return or SPI return. First you will not get whenever you have calculated. I hope all of you have calculated return through Excel. Whenever you calculate, when you say PT divided by PT minus 1, you will lose one information because before that PT minus 1 is not available. So that's why you are getting not applicable. Then you are getting the return series. Up to this, all of you have done.
Yes, sir. Yes.
So
Yes,
rest
sir.
we will do in next class. Let us take the attendance first before we close down.
should we just put it in the chat box or should we go by name by name?
No, there are 30, more than 30. Don't keep in
Acha,
chat
okay.
box because it is a tedious process for me. So the last class was, I have kept it in, last class was 11th, right? I'll correct this date. Yes. So Akash, Anchal, Adyasa, Ayush, Adyasa, Tejas, Ali,
Ali present, sir.
yeah, Anjali, Amul,
Present, sir.
Amul,
Anmol, present, sir.
yeah, Anmol. So Arismita, Avani,
Present, sir.
Ayushi,
Yes, sir.
uh,
Sarvesh present, sir.
Sarvesh,
Sir.
Bhavya. I'll just increase this. Yeah, Bhavya, Cherry is present. Okay. Diksha,
Present, sir.
Dipans, Gaurav,
Present, sir.
Gaurav Santosh,
Present, sir.
Himanshi,
Present, sir.
Jaideep,
Present, sir.
Ayushi, Krishnakant, Kirti,
Present, sir.
Mansi,
Present, sir.
Mansimaran,
Present, sir.
Manvi, Mihir,
Present, sir.
Muskan,
Sir, she was present, but she dropped due to internet connectivity. She just texted me.
Namrata,
Present, sir.
Neil,
Present, sir.
Nikhil,
Present, sir.
Prasun,
Present, sir.
Pratik, Rachit, Rahul,
Yes, sir.
Rahul Giri,
Present, sir.
Rahul Goswami,
Present, sir.
Rajaditya,
Present, sir.
Rasi Jain,
Present, sir.
Risav, Ruma,
Present, sir.
Sahaj,
Present, sir.
Samiksha, Saranya,
Present, sir.
Shubham,
Present, sir.
Shubham Kumar,
Present, sir.
Someshwar Ramshankar, Stuti,
Present, sir.
Sanika,
Present, sir.
Binay. Okay, thank you all.
So just one question I have.
Yeah.
If you could spare like 5-10 minutes.
Yeah.
So
Yes, ask me.
yeah, so sir, I'm working on building a portfolio right now. It's just so it's kind of a pet project which I have. So what we learned today, I'm also trying to optimize my asset allocation. I've just started like a few days back, and the biggest issue I'm facing right now is how do I filter out the data? Like, how do I compile the data? I've downloaded the data from Yahoo Finance. Okay. So what I've taken is I've taken Nifty 500 stocks from Nifty. I've downloaded their data through Excel. I did I ran a script and all.
Nifty 500 you got from Nifty 500 index or company data?
No. Each and every company.
The
20 years
Yahoo
data.
Finance is giving?
Yeah, I'm able to.
Okay.
So for each and every company, so right now I've got 500 files. So now first question is, how do I is there a way for me to run my calculations on all of these files together? Because otherwise opening each and every file and then computing the standard deviation, mean, etc. Gonna take a lot of time. I've tried Power Query, but again that's too very time consuming. It will not work.
All of your files name will be same, na? Column name?
Their file, no sir. Column name will be same. File name will be as per the script name and for NSE.
File name will be the script name.
As per NSE.
If you combine them,
how do I combine 500 files? That's the issue. So one idea was to make them into 500 sheets on the same workbook, and then maybe use an Excel macro or something.
If that you can do, it will be good enough. Because again, you want to build for all the 500, na?
Yeah, because so basically, I'm just getting started, so I'm not even sure what I'm gonna be doing. But I figured mean, standard deviation, these basic data I'm going to need. Returns, वगैरह and all, annual returns and all.
Basic you need, you can do it through Excel itself. But if 500, this portfolio theory cannot be applied with 500 also.
So the idea is to build an ideal portfolio. So my project is to build a portfolio, preferably, if possible, building an automated workbook, maybe with a combination of solver or something, such that I can such that I can automate such that I can just give my desired level of risk or return, and the solver will automatically compute an ideal portfolio for me. Something like this.
Okay.
I know it's a very long shot.
Then you do through Excel itself.
Is it possible through Excel, sir? Because again, see, I can shrink it down to Nifty or Sensex 30 or something like that, Nifty 50 or Sensex 30 stocks. But the idea would still remain the same, right? I need to pool all this data into a single source. Then only I can make it work.
Yeah. So if you bring down to 50 or 30, I'll do it in Python next class. This portfolio theory only.
Okay.
I'll show you how to do directly. You can.
But it's not scalable, sir.
Scalable means?
If I'm doing it on 50, then the process for doing it for 500 should not change, right? It's just a matter of changing syntax.
Yeah. See, there it is very easy. You can download data through NSE website only from Python. That
each and every one.
Yeah. Each and every one. NSE PUI one package is there. It gives all the companies, listed companies at NSE's data. Only you have to give the NSE symbol there. You can.
That is ready. I have that already.
Yeah. So we'll do that. You can automatize with that Nifty 50 companies or Sensex 30 companies. Nifty 50.
So Nifty 500 would also be available, no?
It is available. Only I am concerned about after that building this portfolio model. See, this quadratic equation is applied in the portfolio model. If you are actually doing this model, simple mean and standard deviation will not serve the purpose.
Yeah, of course. I'll need a lot more things.
So this portfolio theory will maximize your return and minimize risk based on these weights and covariance. So if you apply this, just you attend next class, you just see how we are doing. Then you discuss with me whether you can carry out that with 500 companies.
So I can even start with just 10 companies for now.
That is
it's a pet project.
My thing
is. Project right
you
now.
just start with 10 companies or 8 companies or 20 companies.
Yeah.
Okay.
And one more thing, sir.
Yeah.
So I wanted to do some back testing also for my portfolio. Like if I want to simulate the returns based on different allocations. So I'm able to find some software, but it's only for the American markets. Is there anything for India for back testing? Like I can just decide, like, I can just decide, suppose 10 scripts, I can give my allocations and my dates of
See, one
investment, and
money
it's
bhaya
gonna
is there. One money
simulate them.
bhaya. Only one money control has money bhaya.
Okay.
Something. Just see that.
Okay.
Just see that if that is giving you portfolio. Yes, maybe they will give. Just try with money bhaya. And others I'll look into it. Yeah.
Okay, sure. So I'll read more on this. Then maybe I'll get back to you.
Yeah. Yeah.
But you're saying, but like from what you're saying, Python or R would be a much better tool for this than Excel. For what I
Yes,
want to do.
definitely. It will be more quicker. With Excel,
Because
you
I'm
will
more
struggle
comfortable
a
with
lot.
Excel. That's why.
Yeah, you will struggle a lot in Excel. Your time consuming will be more.
Acha, okay. Sure, sir. Cool.
Okay.
Thank you.
Okay, welcome.